All right, let's dive into Shopify's Q3 2025 earnings. Based on a really sharp analysis from BGVC, there is a fascinating puzzle at the heart of their latest report. And honestly, it's a story that teaches a crucial lesson for anyone investing in high-growth tech stocks today.
So here's the big mystery we need to solve. Shopify absolutely crushed its earnings. I mean, they beat expectations on pretty much every important metric you can think of. So the stock should have skyrocketed, right? Well, it didn't. It fell. So what on earth did Wall Street see that so many others missed? That's exactly what we're about to find out.
And you know what? The BGVC report gives us the answer right up front. The market didn't panic because something was wrong with the company itself. Shopify doesn't have a quality problem, it has a valuation problem. And that one simple idea, well, that's the key to this entire story.
Okay, so let's put on our detective hats and start the investigation. Part 1 of our financial forensics is all about one thing: business quality. Is Shopify actually a healthy, well-run company? Let's look at the evidence. And our first piece of evidence is a big one. Just look at the difference here. Shopify's reported profit, that's its net income, was $264 million. But the actual cash it generated from its operations was over $500 million. Whenever a company brings in way more real cash than paper profit, that's a classic telltale sign of a very high-quality business. So that ratio of real cash to reported profit comes out to this magic number, 1.94. Now think about that for a second. For every single dollar of profit Shopify showed on paper, it put almost $2 of actual cold hard cash in the bank. This is exactly what you want to see. It's the polar opposite of the accounting games some companies play to look more profitable than they really are. So you might be wondering why this ratio is such a big deal. Well, financial analysts use it as a kind of lie detector for a company's earnings. A ratio above 1 is good. It means your profits are real. But a ratio of nearly 2, like Shopify's, that's the gold standard. It tells you the company's profitability is absolutely not some accounting fiction. Okay, so digging a little deeper, we look at the balance sheet, the company's financial snapshot, and it is remarkably clean. Goodwill, which can sometimes be a place to hide problems, is tiny. And get this, they turn their sales into cash in just 12 and a half days. That's incredibly fast. The only real risk you could spot isn't in their core business at all, but from the ups and downs of their huge investment portfolio. So how did Shopify turn into this incredible cash machine? Well, they made a brilliant strategic move. They sold off their logistics business, the part that required spending tons of money on warehouses and trucks. Now they focus on their capital-light software platform. By keeping their spending super low, almost all of their operating cash turns directly into free cash flow. That's money they can use for literally anything. Okay, hold on. The evidence seems pretty conclusive, right? The business is a fortress, the cash is flowing, which brings us right back to our original question. If the company's quality is this high, why in the world did the market panic? Where is the real risk here? And that brings us to part 2. We've established the company is solid as a rock, so now we can investigate the real culprit behind that stock drop, its valuation. See, this isn't about how the company is performing, it's about how much people are willing to pay for a piece of it. And here it is, the smoking gun. It wasn't the Q3 results that spooked investors, it was the forecast for Q4. Management said revenue would grow in the mid to high 20s. Now, for almost any other company on the planet, 25 to 28% growth would be incredible news. But for Shopify, it broke the narrative, the story of perfect, nonstop, 30% plus growth. And that tiny crack in the story of perfection was all it took. Now, this slide is where it all clicks into place. We're looking at a key valuation metric here, basically a way to see how much a company is worth compared to the cash it earns. Shopify is valued at almost 109 times its earnings. Now look at its peers, Salesforce, Amazon, Adobe. They're all valued somewhere between 15 and 20 times. This means investors are willing to pay 5 to 7 times more for every single dollar of Shopify's earnings. And this quote from the analysis just hits the nail on the head. Investors are paying an exponential premium for Shopify. That sky-high price isn't based on today's profits. It's a bet on a story of flawless, nonstop, accelerating growth, way, way into the future. The second that story shows even the slightest hint of a crack, that massive premium is suddenly at risk. So let's land the plane here and bring it all together for the final verdict. Because this whole situation reveals maybe the most important lesson in investing: the huge, critical difference between a great company and a great stock. And this is the core takeaway right here. Shopify is, without a doubt, a great company. The fundamentals are strong, the cash flow is fantastic, but
A great investment is a great company that you buy at a reasonable price. And that second part, the price you pay, is where this whole debate really lies.
Which leaves us all with this final challenging question. You have a fantastic high-quality business on one hand, but on the other, it's trading at a truly breathtaking price. So when the company is this good but the valuation is this high, what is the right move? That's the multi-billion-dollar question this whole situation leaves us wrestling with.